That's why I love real estate, because there's always things happening in cities and states and counties, whether it's politically or whether it's weather or, like these hurricanes or the, floods or, whatever they might be. There's migration that people move around. The pandemic or the work from home thing changed things a lot. All of that changes where people go.
Alrighty, folks, we have one of my heroes back on the channel, Mr. Ken McElroy. We were lucky enough to catch up with him a few weeks ago. We got him back. We're going to talk tariffs, big, beautiful bill. We're going to talk limitless. But I want to talk about this masterclass he has coming up this week about how to survive the new economy before it is too late. How you doing, Ken? You got some dogs in the background?
Oh, I'm sorry. Hey, Kyle. Sorry.
Okay. It's all right.
Kyle, I'm on a Zoom. Sorry, my son's
It's all right.
sick.
No worries. That's okay. That's all right. So let's get into it. How to survive the new economy before it is too late. What's that all about this week?
Well, as you know, there's a lot going on, right? So one of the reasons we have Limitless, which I know we're going to discuss, is there's a lot of confusion. I just was at I'm up in Coeur d'Alene, Idaho, and I was just at a big party with about 40, 50 real estate folks. And I'm talking about AJ Osborne, self-storage. I'm talking about Pace. I'm talking about Brandon Turner. I'm talking about Tara. We're all there. Obviously it all kind of goes toward real estate, what's happening. And there's, as you know, a ton of stuff going on with the lenders, with the debt funds, with the cash calls, with the LPs, the GPs, the tenants themselves, rates. So, so we're all over the map. And the cool part is that everyone is in different classes, primarily. And so it's really systemic, Michael, across all real estate classes, right? Like everybody's feeling it right now. There's a few industries that I think are doing okay, but everybody's feeling it. Like listings are starting to stack up because of that frozen equity. People aren't really dumping in. And so I think a lot of people are just frustrated. They're confused. They've had these good times, and now they're trying to figure out what happens next. And so that's what this seminar is for this week, is to try to unlock some of those things, answer some great questions.
Yeah. One of the things that I've been following, and we talked a little bit about last time, is it does seem like Class A multifamily, again, an area you play and you know well, has kind of already had its reset, 20-25%. It's kind of transacting, but there's still a lot of pain in the value add Class B, Class C. Frankly, it was frankly overpaid, right? When cap rates compressed, Class B and Class C went really, really close to Class A in a lot of markets, and that's not normal. And that just means a lot of pain is coming. I'm hearing about a lot of GPs who did value add deals that are, need to do capital calls, can't raise. And now they're on the cusp of, foreclosures. And, the banks won't extend and pretend forever, I don't think.
No, they already have been, as you know. And let's go back, though. And I think this is really the real reason that you and I do this stuff. They shouldn't have bought, right?
No,
now we just need to say it, right? And that really needs to be clear, because that's the whole point of these darn YouTubes and these podcasts. Yeah. Like, there are absolutely positively things that showed up during that period of time that people ignored, and they were red flags to you, to me, to all the people that have been around this. And they're as simple as, putting hard money down without even seeing the property, right? No due diligence, they the things that people were doing to try to stretch to buy deals during that period of time, that you and I know you and I have spoken about this. So they put themselves and their LPs at risk during that period of time for buying that way. And so now it's showing up. Now, so I just wanted to say that, because that's now we're actually starting to see it. And the market does go down. It's gone down when I've owned. It's gone down when you've owned. Rates go up. They've gone up a lot when I've owned, when you've owned. Expenses go up. Vacancies go up. this is part of it. And what we just got through was a bunch of, rent growth and easy money and low rates. And a lot of people jumped on board and they forgot about the basics.
Yeah, it's really funny. I did a video 3 years ago because I'm an accredited investor, and I do deals, right? Myself, my wife and I, much smaller than you, but still, we built a decent portfolio, and we were net sellers in 2019, and then things got wacky. We sold a little early in hindsight, but who knew a pandemic was coming? But to see a market like Fresno, California, which is the market I know best, typically Class B stuff trades at like an 8.5 or a 9. I sold it like a 6.5. They go as low as 5.
Yeah.
I'm like, my goodness. And this stuff's going to revert to the mean. It's going to go past. It's probably going to go to a 9 or a 10 in this cycle, which means that just means every deal done was a bad deal the day it was done. And it blows up when the debt blows up.
That's right. And so that's what we're seeing now. And so I think it's important to realize that, if you're a GP and you're about ready to be one, or you're an LP, yes, you've got higher rates. Yes, you've got higher cap rates. Yes, you've got higher expenses. And yes, you have syndicators that don't understand how to manage. That's what's happening. And so now you have these debt maturities coming. So you have all that. And I think what that's doing is it's, I love the Warren Buffett quote, like you see who's swimming naked when the tide goes out. Well, the tide is, it's almost all the way out and not quite there, but that is exposing some just incredible opportunities to the people that have been around a little while.
Yeah, this is where it's really funny because again, yourself and I were not very active in acquisitions 21 through 24. But you are already active in 2025, and I'm certainly hunting. I want to talk about the pain cycle because again, I think Class A it's functioning, but I'm not sure that Class B and Class C are yet. So if you were going to use a baseball analogy, just Class B and Class C, would you say we're in a third or fourth inning, or do you think we're as far as the 7th inning?
Oh no, we're not that far. Yeah,
okay.
We're probably third or fourth. And I'll tell you what, like just to explain what's going on. So when there's all this new construction that hits the market, that obviously is Class A. And then you have a lot of concessions. So 1 month, 2 months. We've even have some markets that are 3 and 4 months free on a 12-month lease. Just ridiculous.
Wow.
Yeah. You look at downtown Phoenix right now, you'll see in some spots. Now, these are brand new Class A elevated, beautiful lobbies, that kind of stuff. 4 months free. That
is wild.
They're toast, right? And so now you can just go 10 miles to Tempe or to to Gilbert or Chandler, and you're not going to see that. Scottsdale, you're not going to see that. That's just in my market. Now, so let's just walk through that though. When you can do 2 months, 3 months free at a Class A, you're actually competing with Class B and C.
Of course.
Because now that person that would have been at a B is going to say, I can get a brand new place for the same net price on rent. And so what happens is when you start to see these big concessions in A, it just pushes it all the way down. And so it affects all asset classes. And so, yes, you're right. A was the first one to kind of be exposed, but it's like a rock going downhill,
Yeah.
So yes, now that's what's happening is anybody who's in that value add space, whether it's a B or C, it's irrelevant really. They're competing with the brand new construction that's offering these big concessions because now the rents that they projected are the same rents that the tenant has a choice with at a brand new project. And so that all needs to clean itself up. And I actually think that we've got a good year to a year and a half left of that in many markets. Yep.
Yeah. I think we've got a year and a half, maybe even upwards of 2 years. Because again, I've been through this cycle before. In the GFC, it obviously started with single family homes, but multifamily wasn't left immune, right? We picked up several buildings that were frankly bled dry. That's what I remember about the last cycle, right? You're an owner of an asset that you overpaid for. It was a bad deal the day you closed. you get into debt maturity, the bank comes over, extends and pretends, but you stop investing in it, right? Because you're on the cusp of losing it. So you just, band-aid it, and the property just falls apart, right? We bought a building that was initially listed at 144. It was an 18-unit building, 1.44. We bought it for $700,000 after the bank let the owner bleed it for 2 years. Right. So, this kind of pain is coming.
Yep. And I'll just say, we weren't immune. So interestingly enough, I like to hold stuff long term.
Yep.
So we have several projects where we've renovated. We're on our third renovation. You know what I mean? Like,
wow.
So we renovate when we buy it, and then when you renovate it after a cash out refi, that's the second time. And then when rates were down,
Sure.
so these were internal deals that the investors were already out. They've already gotten their money back. They were cash flowing great. And we're like, okay, it's 6-7 years now. They're getting tired. So we did some stuff like that. And where the rates went up, right? And we started these renovations, and all of a sudden we're like, they weren't new acquisitions. They were like, things that we were keeping. And
sure.
We had a heck of a time dealing with rate caps and dealing with these higher, expenses and all this other stuff that was going on. And so we weren't immune to any of it as well. And we exited some stuff. Thankfully, we were in the money. We had done fine on these buildings. Some of them we'd owned them 10 years, but you at some point you got to cut. We also did what something that a lot of people aren't used to. It's called a cash in refi.
Oh,
so most people are do cash out refi. So we had a project in Tucson where we're like, and it was a tail end of a lease up on a new construction deal, and we're like, like we don't know how long where these rates are going to run. And so Ross and I were like, we got to put $1 million in.
Wow.
To hedge the rate. So we did that. We literally did a cash in refi to lock the rate.
Amazing.
So that we knew. So there are things you can do, but if your entire game plan is based on buying something at a low rate and refinancing it later with these big value adds, that game's over.
Yep.
Because of the cap rates are up and the interest rates are up and all that.
Yeah, one of the things that's going to be interesting if I were to fast forward the clock a couple of years is it's probably going to be, and it probably should be, net harder to raise private capital across the board. Maybe not for a guy like you who's got a track record and can point to surviving this with pretty easily. But this whole raising LP money with one YouTube video or Instagram post, that's going to go away, I would think.
Thankfully, yeah.
Yes, thankfully.
Yeah, everybody asks me why do you do YouTube, and I said, well, I'm one of the old guys, on YouTube with 30 years of experience. So, and so I just talk about that, and I think it's refreshing to a lot of folks. But to your point, there's a whole heck of a lot of people that use it as a platform to raise equity. I used it for two other reasons. I used it to, one, brand awareness. How do you let a little company like ours out of Scottsdale, Arizona, how do you let more people know about what we're doing? And then also to highlight my people. We have some incredible folks on site doing some cool stuff with the property management company and our deals and all that kind of stuff. So, and then just by doing that and talking, real, I think it's boded well for us.
Yeah, the thing I really appreciate about your channel, because I'm on it each and every week, if not every day, is you never fell into the doom loop, right? One of the things about creating content on YouTube is if you do Crash Bro type things and doom and fear, it gets a lot more clicks. And you never went that way. You've been always authentic, always just telling what business you do, which I really appreciate.
Yeah, I think it's funny because, I don't need YouTube. I don't need the income from it. I actually have never taken a nickel from it personally, ever, not once. I use it to, pay a video guy or pay a,
big mission.
Help me leverage my time, really, mostly than anything. So I use it to highlight I think what is an incredible industry, which is real estate.
Yes.
And I tell you, the people like us, we're far and few between. You know, like real solid people that are investing fundamentally correctly over the long haul, been in it a while. You know, we're the old guys.
Yeah, we got 50 years combined, 55 years. It's crazy.
Yeah, and I think that will be good for. I would hope that more and more people with the experience like yourself would jump on, and because that's actually what YouTube should be. And
Agreed. Yeah, you put out a post on Twitter, Twitter or Instagram, I don't, maybe both. It basically said one door is better than none. You don't need 100 to start, just one. And as the one rental at a time guy, I love that message, obviously.
Yeah. Well, it's how everyone starts, but it's not what everyone sees. Like they look at, like 30 some years of just getting the heck beat out of me, like, but I started with 1 2-bedroom, 2-bath, my own cash, cash flow like $100 a month back in the day. And then I did a second one. Then I was out of money. Like, just that's the story. That's the truth. And I think that is the journey. And so this is a long game. The deals, as you know, aren't easy to find. And when you do find them, hold on to them and let the tax law do its thing.
Yeah, that's the key to wealth. I mean, wealth formula for me is really simple, right? Create discretionary income, become an elite investor at something. I don't care what it is. And then step 3 is do it for a decade, right? Do it for a decade doesn't play very well in the social media era.
Yeah.
Every millionaire I know, it's a decade. It's a decade.
It's quiet too. Like
it's quiet.
The tenants pay it off, and it's funny. I'm exiting some things right now, and I'm using this new tax law, this bonus depreciation that Trump just signed. Thankfully, I was hoping that he was going to sign that. It sure looked like it because it passed the House and Senate, but I wasn't sure it was going to happen, but it did, and so we're exiting, and so. As I sat down with my accountants week, they're like, well, you've already used all the depreciation here and you've already used it here. And I'm like, oh man. So I'm on the other end of that where I'm like, oh, this is now I really have to figure this out on the depreciation side. And it's funny because we have about, 1,000 investors at this point, I think, but half of them, Michael, have been with us so long, they have the exact same problem, as they're trying to exit and take care of their families or their extended families or their kids or trusts or whatever they're doing. They actually have a tax problem.
Yeah.
More than the passive income problem when you first start, right?
Yeah. Depreciation recapture is a real thing for sure.
Yeah, I know. Well, thankfully we got this 1031, the opportunity zone, the bonus depreciation, all that stuff is, and if people don't know what that is, you should, because that actually, because you can take things, you can take properties that you have a lot of equity in and legally and roll it into something bigger, better, that makes more money without paying tax. It's that 1031 tax deferred exchange is really, really important.
Yeah. Well, let's talk about the big, beautiful bill. It obviously is signed now. It is in force. There's a lot of real estate stuff in it. If you really kind of peel it back, not only bonus depreciation, but incentives for manufacturing and improving buildings. For a guy like you, the big, beautiful bill is like, well, I'm not paying taxes this year. There's gotta be, that's certainly true.
Yeah. Well, first of all, these tax laws, as many of them have been on these. We're just getting back to the way they were. So a lot of people are bitching right now, but a lot of these things, most of them are kind of where it has been. And for guys like us who've been around it. So it's nice to have bonus depreciation back because it was that way for years. Biden, I think, had it down to 40%. Next year it was projected
20,
down to 20. And the 1031's been around for over 100 years. The opportunity zones are permanent, which are huge. That alone is, in my opinion, just one of the greatest things, because you can sell stuff, as you know, and have a capital gain, and then identify an opportunity zone and roll it in there. And after 10 years, that goes away. And now that might sound like a long time for some of you, but
not that long.
it's not that like it catches up quickly. And if you're in the estate planning stages and you're doing things for the long term, like us, like I don't like to sell. I like to hold. I like the cash flow. And people are like, you have so much equity in your stuff, and we do. You know, we have, I don't know exactly how much, but could be upwards of $1 billion of imputed equity sitting in all our assets.
Nice.
If I sold, it would have massive. I would have half that, maybe.
Oh yeah, at least half.
Yeah, like it would, half of it would go to the government, and everybody's like, "Well, you get the other half." I'm like, "Well, that's not the point. I don't want to give half to the government, and don't forget, I get all this cash flow on that. Like, there's massive cash flow that comes in. It's all invested, and so, but if you just understand the game, you can, as you know, brick by brick, literally put these things together, and legally take use the system that they've given you.
Yeah, I've often tried to tell people, and it doesn't land always, that the tax code is a reward system, not a penalty system.
Correct.
And if you look at it that way, it really changes the game.
Well, I tell you, you know, I'm friends with Tom Wheelwright. You know, we go way back, and he said something to me one time. You know, he's a CPA for us. Great book, Tax-Free Wealth. You know, he's just a world of knowledge. And he said, listen, he showed me the tax book. It's like huge, thick. And he's like, this is all the stuff in there. You know, it basically says what you can't do. And then he's like, and there's a little piece in there that says what you can do. And just focus on focus on that piece. Just focus on the piece that you can do. And you know, that's whether it's energy or oil and gas or real estate or affordable housing or tax credit stuff. There's a whole bunch of stuff in there that the government wants. And he said, if you just pay attention, the government actually wants to direct the public money to something. It doesn't really matter what it is. Like, that's the whole game, is how do you get money from the public and direct it to certain things for tax benefits? And he's like, if you just understand that and focus on that, you can legally reduce, because I think taxes are, for most people, 40% expense. They're the biggest expense of their life. Like,
agreed.
People don't realize how much tax is. And so you can legally guide it that way. And by the way, as you know, we still pay sales tax. We still pay property tax.
Oh yeah.
We still get the taxed quite a bit.
You have employment tax yourself. You're paying lots of taxes.
Yeah. So, you know, we don't avoid everything, but when it comes to a capital gain or something like that, you know, there's a lot of ways legally that you can reduce that.
Yeah. I love that. Well, one of the things I love about you, again, you going out there as, you know, one of the old guys with me talking about what you're actually doing, is you're calling your shots. I love that about you. Yeah. It says in one of your posts, you're starting to buy in North Dallas. Ken, don't you know that Texas is trash? What the heck are you doing buying in Texas?
I know. Like, so here's the thing. Like, if you just look at, I pay attention to where, you know, people go, period. So if you look at the top states, Texas is one, Florida, North Carolina, Tennessee, and Arizona, they're all in the top 5-ish, depending on what study, but that's where a lot of people are going. And so if you just pay attention to that and then where there, and I think there was over 500,000 people that went to Texas in the last 12 months.
Yeah, probably. Yeah.
So just a crazy number. Now, Texas is huge, so it doesn't mean they're all going to North Dallas. But what people do is this, Michael, and I do this, you do this. We know people that do this. If you have a family, you go, where's the best school system? The best school system, hands down, is in North Dallas, period. If you take a look, there's all kinds of reports on that. And if you're in a public school system, that's one of the big factors. Now, obviously, you got to be working in Dallas too. But if you work downtown Dallas and there's a great school north of Dallas and you're married, you're living wherever your wife says you're living. You know what I mean? Like, for those kids. And that is a fact. And so there are all these little things that not so little, but if you think about them practically, that you can kind of do to make good decision making. And there's a reason why Plano, Frisco, Carrollton, you know, some of these little markets that were all, well, you know, we've been investing in those for 15 plus years. they're blowing up. And so it's a real kind of a common sense business. Is where are people going? Be there and play the long game.
Well, that and the fact that something you didn't say, and back to Warren Buffett's quote, I always like to go where everybody's running from. I mean, those are where the opportunities are. Motivated sellers, get creative with financing, get banks to loan you money.
Yep.
I don't mind, right? If everybody's screaming Texas is horrible, I'm probably looking there. It's just how it works.
Correct. Yeah, that's the other thing. You bring up a very good point. So on the other side of that, there's massive opportunity, and that's actually what we're starting to see now. That's why I love real estate, because there's always things happening in cities and states and counties, whether it's politically or whether it's weather or, like these hurricanes or the, floods or, whatever they might be. There's migration that people move around. The pandemic or the work from home thing changed things a lot. All of that changes where people go. And there's so many ways to figure that out. The driver's license is turned in, the U-Hauls one way.
Yeah, U-Haul one way.
Yeah, North American van lines, the cell phones. Everybody knows where you are, whether you like it or not. So there's all these interesting little things that can help you make really good decisions, because, as I like to say, it doesn't matter if you own real estate. It only matters if there's renters.
That's true. It's right. That's right. One thing I wasn't going to ask, but I'm going to go here just because we're vibing so well.
Yeah.
You and I are, we're older than most investors, right? We're on the other side of maybe, we're on the other side of 50. Let's just leave it at that. When is enough? I mean, you've been doing this a long time. You clearly don't have to do it anymore, but is it just a game for you? Is this how you have fun now?
Well, yeah, great question. There's a bunch of stuff going on in my mind. The first one is I have both my young boys. I call them young. They're in their 20s working for me now. So
there you go.
There was a time where I was going to exit. And now I have this whole new, all of a sudden now they're in, they look under the hood and they go, oh, you really, they have no clue, right? They're like, okay, this is cool. And so now I'm in this really cool opportunity. They're both here. I'm in Idaho. They're both here. Nice. And to be around them, talk to them about property management, acquisitions, how it works. They're both in the company. So that actually has given me, the second thing is that Ross and I, my partner, who's a little bit older than me, we're like, well, how do we keep the company? We've got 300 people. And bring in new folks, or reward people that have been with us a long time by giving them pieces of the GP, and change their life. And so we've been doing that for 4 or 5 years now, where we find a deal and, we give our CFO and our head of maintenance and, people that have been with us a long time pieces. And so all of those things. And then the legacy piece, selfishly, I love managing my own money. I've had friends.
Me too.
I've had friends exit, and they're like, all we do is manage wealth managers, and they're in all these different products that they don't fully understand. And for me, I get real estate, so I'm creating this kind of board scenario where I can weigh in quarterly. I got my kids in the environment. I'm rewarding the people that have been around. So, you sell and then what? And
then what? Yeah.
And my life's not going to change much,
right.
From today to, if you add a bunch of zeros at all.
Yeah. As somebody who's been in the game 30 years, is the Monopoly board game just remarkably accurate?
Yes, it is. Well, I'll tell you, there's one really interesting thing in the Monopoly game that a lot of people don't think about, and that is the bank. So in the rules, literally in the rules, it says that the bank could print as much money as it wants.
If you run out of money, just print more.
So I was laughing at when I read that once. But yes, it is. It literally is very similar to that. Now, the cash out refi, of course, I would add that because I would add some stuff around tax. Of course, that changes so much, so it'd be hard to do. But it is absolutely accurate where people are landing on there, paying you rent, and the people that own those properties benefit.
Yeah. And the other thing is, can you imagine playing Monopoly and never buying something you land on?
No.
I mean, come on, right? That's a way to lose.
It is funny because the people that, as a kid, I remember, oh, I don't have the money to buy it. I'm just going to keep moving on. And I'm like, oh, yes. I don't actually think I ever landed on something and didn't figure out how to buy it.
No, exactly. That's the whole point.
Yeah. And then I love Kiyosaki. He's
the
like
cash flow board game. Yeah.
Well, I love what he says. He says 4 greenhouses, 1031 red hotel. He adds
the 1031. Yeah, that's exactly right. That's amazing. That's amazing. Well, let's get to Limitless. You're putting on your event. You've got a lot of rock stars coming. I think Limitless is coming at the right time. Again, I think we talked about earlier, there's a lot of wealth to be created, but you got to do it safely and rightly. There's been a lot of bad actors the last couple of months that are going to lose a lot of LP money. You're not one of them. And that just goes to show being conservative is okay. I know sometimes, at least I was called a boomer, right? I remember going to a short-term STR event, being the one rental guy, and I was called boomer, which really was insulting because I'm not a boomer. But it was like, you guys don't get it, right? This party could end, and sure enough, it did. So I think Limitless is coming up at the right time. Tell us about it. What's going on?
Well, I tell you what's been really interesting is, first of all, this is my 4th year. What's really, really been interesting, Michael, is the people that sponsor us. So that's really been interesting. So go back 4 years ago. Who were they? Capital raisers.
Interesting. Okay.
0 capital raisers, right? So it's just funny to see like the businesses that, because we'll do $1 million in sponsors. These are people that want to be on stage. We got 2,000 people, 50 speakers, 5 stages. And so my job and Tarl's job is to make sure that we're relevant that year for what's on people's minds, period. So we have a big, beautiful bill tax panel. We have a manufacturing panel. What's really going on with tariffs, right? We have a gold and silver panel. We have oil and gas panel. We have water, timber, energy, natural resources panel. And we have, of course, a bunch of real estate panels. But this year, I really brought in a half a dozen like big time economists. So if you ever follow Jeff Snyder with Eurodollar University, he's coming. We got Jim Rickards. He's coming. We got Kiyosaki. He's coming. We got George Gammon. He's coming. We got Brent Johnson. He's coming. It's really like, these are, if you guys don't know who these people are,
look them up.
Huge followings. And the reason why I've got Larry Lepard, who did the big print, the book, by the way, I would highly recommend you read that. He's coming. He's coming in from Boston. I've never met him, but I've spoken to him. I read his book multiple times. Just about the way the economy is working. Brent's going to talk about central banks. To me, this is all super confusing. I mean, I try to figure it out. I read what I can read, and I watch what I can watch, like you, and I'm trying to make sense of it all. So I'm excited. When Larry told me that him and Jim are often at odds, I go, great. You guys are on the same path.
Let's go. Exactly.
Yeah. And so I think, to me, that's healthy, good debate. Like, George believes interest rates are going down, as an example. Brent Johnson doesn't necessarily. They have really good points. They're really smart people. And so let's have
let's have the debate. Yeah.
And so that we packed it with that. And we obviously got a ton of single family guys, build to rent guys, self-storage guys, multifamily guys, debt guys. And so we just try to cover it all. So it's something that I would want to go to, and the room is actually full of more of a high net worth accredited vibe. I'll bet you 500 to 1,000 of those there, because they're all confused too, and they're going there for answers. And so anyway, it's been a blessing, this whole thing. Every year we do it. It's just, to me, it gets clearer and clearer and clearer that no selling from stage too, by the way.
Love that.
And we hand vet everybody. So we're like, okay, this person's going to tell the truth. Like, how do you lose money in oil and gas? Like that's the topic, right? Not buy, and here's why. Like, that's all a bunch of BS. So that's kind of where we like to keep it.
So when is it and where is it?
Yeah, it's at the July 31st, August 1st and 2nd, and the Gaylord Texan.
I've been there. It's a nice facility.
There. Yeah, it's a conference hotel, really, really nice. And it's limitlessexpo.com. And, you know, I guess you've got the code here, 10% off. We are no BS. Obviously, we're just less than a month away. It's pretty highly sold out in many ways.
Nice.
I know that I think the VIPs might be sold out. The elite tickets might be sold out. I think we still have some GAs left, but typically we do sell out. And I don't know why people do, but they always wait till the last minute. By the way, I do that. So I'm like, oh, you know what I mean? So I'm guilty, but I do, because I'm like, it's a time issue, right?
Yeah.
But I think this is a room, especially this year, you want to be in, because of all the chaos that we're going to get right into it with the Trump policies and everything that's happening. So it's going to be very interesting.
Yeah, folks, I'll put a link below. Obviously, that link will work with Ken 10. Get your 10% off. Again, you don't have to use the link. Just go there, get it, get yourself to Texas. I guess we'll close on this kind of a, theoretical question for you, Ken. Do you think the next 10 years will be some of the greatest wealth building opportunities, or do you think it's just, just sideways?
Great question. I do believe we're heading into a pretty inflationary time. And so I think that and that alone is a reason to be in hard assets. So
inflation's a feature, not a bug.
Yeah. Like, so how does that work? Well, I'll just end on this quick story. My mom still has the home that she bought with my dad in the 60s for $10,800. And it's worth 700 now ish, somewhere in there. Now it's just north of Seattle, which is where I grew up. The point is, my mom was a beautician. She did hair her whole life. She's not a real estate investor. What happened was the dollar devalued. That's what happened. The dollar devalued and inflation was her friend. My mom is not a real estate investor, but that ironically, and my dad bought an insurance policy for her at around the same time, about 10 grand. It's still 10 grand. And I was like, so what my dad thought was, oh, this insurance policy is going to take care of your mom, but it was really the house. And it's really interesting. And so if you take a look at what went on with the dollar and you look at what went on with inflation, if you just are in the game, you could have one, you could have two, and just hold on to it and let the tenant pay it off. That, whatever that is for you, it will be, trust me, you'll be so happy you did it. Just a couple is all people need.
Yeah.
And I think that's the biggest thing, Michael. We're going to have interest rates up and down. We're going to have tax policies all over the place. I do think we're in a pretty bad affordability problem for a lot of people. And that actually concerns me a lot because the only thing that's going to fix that is a lot of supply of something, right?
Yeah.
When there's a lot of apartments or a lot of single family, prices come down.
There you go.
So that's it. And then you can buy or can't buy depending on real interest rates and all that. But I think you just got to get in the game. You have to, and by the way, it doesn't have to be real estate. It could be gold, silver. It could be any hard asset you want that is just going to move with inflation over time and set and forget. That's kind of my thing.
Yeah, it's funny. We're so similar. I tell people always, just get to 4. Just get to 4.
Yep.
One every year, one every 2 years, doesn't matter. Let the tenant pay it off. In 30 years, you're going to be a very happy camper.
My sister did that.
Yeah.
Yeah. Yeah. Well, she's a bookkeeper at the Everett Eye Clinic, and her husband worked hard at a Kimberly Clark up there in Everett, Washington. And they bought 5 houses, and that's it over their period of time. And the tenants paid them off. And at the end, when they decided to retire, that's where their wealth was. It was like somewhere between $2 and $3 million paid off.
So simple. Then you can sell, you can refi, you can do all kinds of. You have so many options there. Ken, I appreciate you. You are one of my heroes, not only for what you've done in the past, but more importantly, what you're doing now in social media. I think more and more people who have made it need to stay true to that and tell people the truth, which I appreciate you do daily. Give us your closing thoughts and we'll wrap this up.
Thanks, Michael. I appreciate it. Well, I think my closing thoughts, if I could say anybody, is it really is a great time to get your dry powder together and to start to take a look. If you have a lot of money and you're giving up your resources, financial resources, to somebody else and hoping that they're going to take care of you, that model's over. I think you need to take control of your own finances. Not necessarily, if you don't know how, don't do it, but you need to learn and you need to take control of your own money.
Yeah, love that. Again, folks, don't forget his free masterclass this Thursday. Stop waiting for the old economy to come back. Get ready for it. And of course, Limitless in Texas at the end of the month. Ken, you're amazing. Take care.
Hey, thanks, man.
Mm-hmm.